Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what to expect for the future. Today is August the 15th, 2023. It is now 2:57 p.m. Central Time. We got about an hour left in the trading day for both mortgage-backed securities and the overall bond market. So far, fairly slow on the day. We still have an hour to go, so we'll see where things end. But let's take a look and see at some of the news today that actually could affect home loan interest rates in the near term. So if we take a look at the front page of CNBC here, the first article I want to point out is it says Fitch warns that it may be forced to downgrade dozens of banks, including JP Morgan Chase. Now, again, we talked about that Fitch recently downgraded the credit rating for US debt. Now, Fitch is also talking about downgrading some of the major banks here in the United States, which basically is saying that they have concerns about the health of these banks. Of course, nobody wants to hear that. That hurts their stocks, that hurts their investors, which then affects the movement of capital and the rates they have to pay to get a hold of capital. Then let's take a look here at another article in the same day. Regional banks slide after the Fed's Kashkari advocates significantly further capital regulations. Kashkari is a member of the Federal Reserve Board. So he is someone who is a member of the Fed, and he's saying that he thinks that we're going to need to have more restrictions on some of our regional banks. That's not good for the banking industry either, making it difficult to do business. Now, remember, as interest rates go up, it can really impact every type of large institution that actually uses debt to fund their day-to-day operations. So, I mean, it's just like you and me. It's just like any household. If we are in the habit of using our credit cards to pay our day-to-day bills, our grocery bills, our gas bills, and things like that, and the normal credit card rating or interest rate, let's say, is 20%. And we've been doing that for the past 10 years, making things work, but we kind of do need those credit cards because we need to get paid to then pay those credit cards off, and we keep repeating the cycle. Well, all of a sudden, that credit card that was at a 20% interest rate is now at a 29% interest rate because of the increases by the Federal Reserve to the federal funds rate, which directly affect credit card interest rates. All of a sudden, at the end of the month, when you get your check and you go to pay off your credit card, there could be potentially an amount of interest that didn't used to be there. And all of a sudden, you're like, oh, wait a minute, I'm not quite able to pay that. So all of a sudden, the debt is more expensive, which makes all the operations of banks more expensive. And also, the difference of what they have to lend money for. All of a sudden, now they have to lend, if the interest rate that they're getting on money is 7, they have to lend money out at 8, 9, 10, 11, 12 in order for there to be a profit involved. And maybe people are starting to say, I'm good. I don't need a new car. I'll keep my old car and repair it because I don't want to pay that high of an interest rate. That means that banks don't make as many loans, and banks make money by moving money. Okay, so we don't want to see downgrades on our major banks. We don't want to see additional regulations to our smaller banks, regional banks, but that's what's in the news today. So how is the overall bond and mortgage-backed security market reacting to that? Well, we're down 12 basis points. Again, not a huge move, not what we want to see, but not a huge move. The 10-year Treasury is up 3, about on par. Not a big move either way, but definitely not what we want to see. Still another red day. Again, not what we want to see. But again, these are concerns that the overall bond investment market does not want to see. People saying that they're going to downgrade major banks. And this is what the result is. How is that treating our home loan interest rates? Let's go to our scenario here. Run the scenario for the Brent Bruce Daily, the very well qualified 30-year fixed conventional home loan. And as always, if you have a client and you are in California or Tennessee and would like for me to talk to them about how we can structure these lower interest rates, please reach out to me. So the loan store here is now sitting at 7.375 with a credit of 248. I mean, this is almost exactly where we were yesterday. I mean, I want to say we're within $100 of the cost to get a 7.375. If we go in here and we say, what does it cost to get into that 6 handle? About a point, same as yesterday. 5.999, which in this case is a 6.0, is costing 3.961. Yesterday that was 3.8, so a little bit worse on that 5 handle loan that we always try to get a hold of. So that's where we are right now. Again, if you have any questions, make sure that you like, subscribe, share, hit the notification bell up in the top corner. We will see what is going to happen tomorrow with the news coming out from the Federal Reserve on the comments. So we're going to go over the comments that were recorded, so the notes from the last meeting of the Federal Reserve and what they were thinking. Do we want to get into the heads of the Federal Reserve to find out what they're thinking about increasing the federal funds rate here in the September meeting? We don't want them to do it, but we want to know what's going on. Make sure that you like, subscribe, and share. Talk to you tomorrow.